Good morning. Welcome to Market Monday for January 6th, 2025. Happy New Year. In fact, it's been a couple Happy New Years in the stock market, that is. The S&P 500 stock market closed out 2024 with a 23.3% gain, marking the first back-to-back years of greater than 20% gains since 1997 and 1998. Think about that. It's been more than 25 years since we've seen back-to-back 20+% gains. Are you expecting another 20+% gain this year? Of course, here's 2022 right here, a pretty nasty year for both stocks and bonds. But then look at 2019, 2020, and 2021. Not back-to-back 20+% years, but throw in a 16% gain for 2020, and I don't think anyone's complaining. And then, of course, we had the mid to late 90s, one of the strongest and most consistent stock market runs in history. Of course, we're speaking about the S&P 500, which is an index of large U.S. companies. Taking a step back, this is what we call a returns quilt. It shows the returns of several asset classes like large stocks, small stocks, real estate, bonds, ranked from best to worst performer in any given year. Here's large cap US stocks like the S&P 500 in light green. Best performer the last 2 years. Near the top for the past 10 years. No question it's been a great run for the S&P 500 for the last decade. This gray color is what we call developed international. Think Japan, Canada, Europe. It's been pretty mid-range over the past 10 to 14 years. Bonds, like general aggregate fixed income, dark blue, has spent most of the time toward the bottom of this performance quilt over the last 10 to 15 years. Indeed, it has been an equity bull market, so perhaps not too surprising here. Though, as we've discussed here frequently, we should no longer blindly allocate to bonds or fixed income just because. Just because that's what we've always done, just because that's what they teach you in the licensing textbooks. Not going to cut it for us. Not to say bonds are dead forever, but we need to explore perhaps what else is available to us as diversifiers. What will 2025 have in store? Wait, you don't actually want predictions, do you? How about some timeless principles instead? Again, let's expect a double-digit decline this year. Last year, the most we got was an 8.5% decline. Fine. But the average decline since 1980 is over 14%. So just the math alone makes the odds of such a decline more likely this year because we did not get one last year. All good. 23 of the previous 44 years saw a double-digit correction, with 13 of those 23 years still finishing positive. Next, have you ever heard investing in the stock market is like gambling? In fact, nothing could be further from the truth. See, in gambling, the longer you play, the more likely it is that you end up losing money. That's literally how it works. With stock market investing, the longer you play or invest, the higher likelihood you have of winning. On a daily basis, you have about a 50-50 odds of gaining or losing. Play for 1 year, and your odds are already over 70% of gaining. 10 years, you're over 90%, and at 20 years, historically speaking, no guarantees, historically, you gained 100% of the time since 1950. Indeed, investing is the opposite of gambling. Next, there is always a good sounding reason to sell. There is always bad stuff going on in our world. Wars, crises, revolutions, pandemics. Part of our job as investors is to absorb that noise and keep plowing ahead to achieve those returns, which is precisely the reason the long-run historical average in stocks is higher than cash. Not always an easy task. We don't pretend it is. Let's pick up on some of these timeless principles again next week. And today, we'll leave you with the Psychedelics ETF is up 15% since New Year's Eve. Have a great week.